Okay, we're now going to take a look at exercise 1315, dealing with warranties. And let's read through it first. Coppola Awning Corporation introduced a new line of commercial awnings in 2016 that carry a 2-year warranty against manufacturer's defects. Based on their experience with previous product introductions, warranty costs are expected to approximate 3% of sales. Sales and actual warranty expenditures for the first year of selling the product were as follows. Sales were $5 million, and what they actually paid out for warranty claims was $37,500. In requirement 1, they asked, does this situation represent a loss contingency? Why or why not, and how should Coppola account for it? Well, first we need to read about what a loss contingency is. If you flip to page 746, a contingency is just an event that could occur, you guys, in the future. It may or it may not. It just depends on, certain events occur. Then a loss contingency means if certain events occur, then we would have a loss in the near future. Let's read the book definition. It's an existing uncertain situation involving potential loss depending on whether some future event occurs. Whether a contingency is accrued and reported as a liability depends on, first, the likelihood that the confirming event will occur, and what can be determined about the amount of the loss. A classic example would be if a company is involved in a lawsuit at the end of 1 year, but they don't know if they're going to have to pay out. They don't know which way the suit's going to go in the coming year, although they know it'll be decided. If you look at the chart on page 748, they tell us how to handle these possible future losses. So what they're saying is if we know about it at the end of the year and it's likely that it's going to occur, we can estimate the amount, and we'll go ahead and book the liability. Let's look at that chart on middle of 748. If the likelihood of the confirming event is probable, meaning say the likelihood we lose the lawsuit, and the dollar amount of the potential loss is known, okay, it's probable we're going to lose the suit, and we know if we lose we're going to have to pay out $1 million, then the liability would be booked or recorded, and we would tell the details of it in a disclosure note. If the likelihood is probable and we can just reasonably estimate the amount, then we go ahead and record the liability and give the details in a note. If it's probable that the event will occur but we cannot reasonably estimate the amount of the loss, then we just do a disclosure note only. And then if it's reasonably possible that the event could occur, no matter what we know about the dollar amount of the loss, we would only do a disclosure note. And if the likelihood of the loss occurring is remote, then we don't record the liability and there's no disclosure note. Okay, so this situation in exercise 1315, does it represent a loss contingency? Yes. The likelihood of them having to pay out on some of these awnings in the future would be probable. And we can estimate the amount reasonably based on past experience as being 3% of sales. Okay, you guys, so requirement 1 asks, does the situation represent a loss contingency? Yes, it is. Yes, it does. This is a loss contingency. There may be a future sacrifice of economic benefits, cash or parts, cost of satisfying the warranty. Due to an existing circumstance, the warranted awnings have been sold, and I believe I got that misspelled. And that depends on an uncertain event customer claims. So, again, it's a loss contingency because there may be a future sacrifice of economic benefits, cash or parts, the cost of satisfying the warranty. Due to an existing circumstance, the warranted awnings have been sold, and that event, that whether or not we have to pay depends on an uncertain future event, whether or not we have customer claims. Okay, they also go on to say that the liability is probable because warranty claims inevitably entail cost. A reasonably accurate estimate of the total liability for a period is possible based on prior experience. So the contingent liability for the warranty is recorded. The entry would involve a debit to warranty expense in 2016. This is important so that the expense is recorded in the same year that the awnings were sold. We want its associated warranty expense recorded in the year that we sold it. We want to match that expense to the revenue it helped to create, and those warranties help to sell more awnings. Okay, and then the entry would also involve a credit to the account estimated warranty liability. Alright, number 2. Prepare journal entries that summarize the sale of the awnings, assume all credit sales, and any aspects of the warranty that should be recorded in 2016. Okay, for the sale of the awnings, we debit accounts receivable, assuming they were all sold on account, for $5 million. And we credit sales for $5 million. Okay, now for the warranties, we debit a warranty expense, and it's equal to 3% of sales. So the $5 million times 0.03, $150,000. The warranty, we haven't had the claims yet though, so we're going to credit a liability account. Estimated warranty liability. Now for the claims that we had during 2016, what, $37,500. There we would debit the liability to decrease its amount. Estimated warranty liability, $37,500, and then we're going to credit cash or parts or whatever we had to give up to satisfy the warranty claim. The account to credit here could be various things. Could be cash, wages, payable, inventory, supplies, but they, in total, those accounts would have been credited for $37,500 to satisfy the warranty claim. We just don't know what all it took to satisfy the claims. It could have involved some cash, could have involved some labor, which would be wages payable. Could involve some inventory or supplies. Okay, now requirement 3, they want to know the balance in the estimated warranty liability account at the end of the year. I'm just going to move this up. Okay. So we could do it in a T account, but we had credit to the estimated warranty liability. Estimated warranty liability for 2016 was our credit for $150,000. Less warranty claims satisfied during 2016. It's no longer a part of the liability. That was what, $37,500, and then that should get us to our estimated warranty liability at December 31, 2016. $112,500 should be the balance in the estimated warranty liability at December 31, 2016. Okay. You guys, a loss contingency, remember, if it's probable that the event will occur and we can estimate the amount, then we record the liability and do a disclosure note. If it's probable that the event will occur and we can reasonably estimate the amount, then we do the same thing. We would record the liability with a journal entry and describe the details in the disclosure note. But then if it's probable that the event will occur but we can't estimate the amount in a reasonable fashion, then we would just do a disclosure note. If it's only what were their exact words here? I believe it was reasonably possible that the event occurs. Then we only do a disclosure note. We don't record the liability. But then the chances of the event happening are remote. Then we don't record the liability and we don't disclose it in the notes to the financial statement. Okay, you guys, I don't think you'll have any problem with the exercise 315 on the Connect Plus site after doing this one with me. I hope not. And if you have any questions, please be in touch. Thanks a lot. I hope y'all have a great day.